Welcome to the Pro Ticker Deep Dive.
It's great to be here.
And wow, what a day to be here. Today is Monday, February 9, 2026. And I have to say, walking into the studio this morning, glancing at the terminal, the vibe out there is distinct. It's not panic exactly, but it's manic. It's noisy.
Noisy is the polite word for it.
Yeah.
It's one of those mornings where the signal-to-noise ratio is completely, well, it's just completely out of whack. You look at the ticker tape, and you have to blink twice to make sure the data feed isn't glitching.
Right. Because usually the market picks a lane. Either we're in risk-on mode, everyone is buying tech, partying like it's 1999, or we're in risk-off, huddling in gold and bonds. But today, it feels like we have a split personality.
Absolutely.
On one side of the screen, you have these massive, glaring red flags flying over the sovereign bond market, the kind of stuff that usually sends investors running for the hills.
Macro warning shots.
Yeah.
The big, scary stuff.
Exactly. But then you look 3 inches to the right on the same screen, and individual stocks are absolutely ripping. Double-digit rallies, these huge redemption arcs. It's like the stock market is throwing a block party while the bond market is boarding up the windows for a hurricane.
That is a classic split-screen market, and you've described it perfectly. You have the macro story, the heavy, slow-moving, geopolitical tectonic plates grinding against each other. That's the bond market.
Mm-hmm.
And then you have the corporate story, the specific, idiosyncratic narratives of companies fixing their problems or launching new tech. And today, those two stories are they're completely decoupled.
And that is exactly what we are going to unpack, because when the signal gets this messy, that is usually when the biggest opportunities and, I guess, the biggest traps appear.
We have a lot to get through today.
A lot.
We do. Just to give you the roadmap,
Mm-hmm.
we have to start with the heavy stuff, the elephant in the room, or maybe, given the geography, the dragon in the room. There is breaking news out of China regarding U.S. debt.
And it did something to the 10-year Treasury yield this morning that, frankly, made the hair on the back of my neck stand up.
It's the anchor story of the day. Honestly, everything else is just noise if we don't understand that liquidity shift.
But we aren't staying in the gloom. We're going to pivot to what I'm calling the redemption arc of 2026. Applovin, ticker APP.
Oh, that's a wild story.
This stock is up nearly 15% today, and the reason isn't earnings. It isn't a new product. It is a story about crime, punishment, and a sudden, dramatic, never mind.
A fascinating case study in market psychology, really.
Then we're touring the future tech landscape. We've got AMD fighting through some issues, some very loud whispers about Microsoft's new Xbox strategy, and a look at Ethereum, which is currently sitting in what the technical analysts are calling the death zone.
It's very dramatic branding, for sure. But the math behind it is actually quite scary when you dig in.
And finally, we'll wrap up with the final frontier. SpaceX has made a major announcement. If you were packing your bags for Mars, you might want to unpack. The timeline has shifted.
A major reality check for the space race.
So pour the coffee. Focus the mind. It's a busy Monday. Let's dive in.
Let's do it.
Okay, let's start with the hard money, the macro story. It's about 10:30 a.m. Eastern time. The coffee is still hot. Traders are settling in. And boom, we see a tick on the screen that stops everyone mid-sip. The 10-year Treasury yield jumps.
It does. And it's one of those numbers that looks tiny on the surface, but, it sends a shiver down the spine of anyone who's been watching the bond market.
Right. Specifically, it's up 1 basis point to 4.216%. Now, I want to pause here, because if you aren't a bond trader, 1 basis point sounds like a rounding error. It sounds like absolutely nothing. It's 0.01%. Why should I, as a regular investor, even care about a move that small?
And that is the perfect question to ask. Because in a vacuum, 1 basis point is nothing. It's statistical noise.
Mm-hmm.
But in the world of global finance, you don't look at the size of the wave. You look at what caused the displacement. Today, that tiny, tiny ripple was caused by a boulder being dropped into the ocean.
And that boulder is China.
Correct. The news breaking on the wires is that Chinese regulators have officially urged their domestic banks to limit exposure to U.S. bonds.
Limit exposure? That is such polite banker speak. It's so gentle. Translate that for us.
It means stop buying and consider selling. But it's the context that really, really matters here. The U.S. Treasury market is the deepest, most liquid pool of assets in the entire world. It is the bedrock of the global financial system.
A safe haven.
The ultimate safe haven. So when the second largest economy in the world, which historically has been the biggest banker to the United States, tells its own institutions to step back, That isn't just a trade. That is a geopolitical statement.
So let's play devil's advocate here. Is this China saying we don't trust the U.S. to pay us back? Is this a credit default fear? Because that sounds apocalyptic.
That's the knee-jerk reaction for sure. Oh no, they think America is broke.
Yeah.
But we have to be precise here. The official reasoning, the story being circulated from sources familiar with the situation, is all about risk diversification and reducing concentration risk.
Which is the financial equivalent of, it's not you, it's me. I just have too much of my net worth tied up in your house.
Exactly. And to be fair to the Chinese regulators, from a pure portfolio management perspective, they aren't wrong. If you look at a chart of their holdings, they have been massively overweight in U.S. dollars for 20 years. Any prudent manager would say, hey, maybe we should own some gold, maybe some euros, maybe some domestic assets.
So they're just rebalancing. That sounds reasonable, almost responsible even.
It is reasonable on paper, but markets don't trade on paper. They trade on fear and trend. And if you connect this to the bigger picture, this isn't a new phenomenon that started this morning. Not at all.
Right. You have to look at the trend line.
You do. If you look at the historical data, China has been steadily, quietly selling U.S. treasuries since 2014. That is 12 years of consistent reduction.
12 years. So this is a long, slow-moving train.
A very long-term trend. In fact, their current holdings are now at their lowest level since 2008. Think about that for a second. We are back to financial crisis levels in terms of how much U.S. debt China holds.
That is staggering. I remember a time not so long ago when China was the boogeyman in financial discussions precisely because they owned so much of our debt. People used to say, China owns America.
Exactly. For years, they were the undisputed largest foreign holder of U.S. treasuries. But that leaderboard has changed dramatically. Do you know who holds the most now?
Well, looking at the data, Japan took the top spot a while ago, right? Sometime around 2019.
Correct. Japan surpassed China back in 2019. But here's where it gets really interesting, and this is something that happened just last year in 2025. The United Kingdom surpassed China as well.
Wait, really? The UK? I didn't realize that.
Yes. The United Kingdom's treasury portfolio overtook China's. So China has slipped from number 1 to number 2 and now number 3. So when we see a headline like today's, that regulators are urging banks to limit exposure, it's really just an acceleration or a confirmation of a strategy they have been executing for over a decade.
That puts it in perspective. It's not a sudden act of aggression. It's a continuation of policy. But, and there is always a but in markets, this is just business as usual. Why is the market twitchy? Why did that 1 basis point matter so much this morning?
Because of the method. There is a huge difference between a slow, quiet sell-off over 12 years and a regulator issuing a public-facing directive to banks on a Monday morning. The nightmare scenario, if you will, is all about speed.
Speed kills.
In the bond market, absolutely. We have to talk about what traders are actually afraid of. The nightmare isn't that China sells, it's that they sell all at once.
A fire sale, a liquidation event.
Exactly. If they decide to exit the position rapidly, a large-scale selling program, there just aren't enough buyers in the world to soak up that supply without the price crashing. It's simple supply and demand.
And I want to make sure everyone understands the mechanics here. This is crucial. If bond prices crash, yields spike. They move in opposite directions.
Correct. It's a teeter-totter.
Okay.
Price down, yield up. And yield is just a fancy word for interest rate. It's the cost of borrowing money.
So if China dumps bonds, the 10-year yield goes from 4.2% to, what, 5%, 6%?
Easily. Maybe higher in a panic. And that is where it hits the listener at home. The 10-year Treasury yield is the benchmark for everything in the U.S. economy and really the global economy. If that yield spikes to 6%, your 30-year fixed mortgage rate goes to 9% or 10%.
Wow.
Overnight.
Wow.
Auto loans go to 12%. Corporate debt, the money companies borrow to expand and hire, becomes incredibly expensive.
And that stops the economy cold. Full stop.
It creates a major disruption. It triggers a recession almost immediately. Now, to be clear, the reports today said China didn't provide guidance on the size or the timing of the reduction. They left it vague.
Of course they did.
But that vagueness is what makes traders so nervous. Even a small limit exposure order makes you wonder, is this the start of the big dump? Is this the first tremor before the earthquake?
It's the uncertainty. Markets hate bad news, but they loathe uncertainty.
Correct. And that is why you see that 1 basis point tick up. It's a pricing in of risk. It's the market saying, okay, we believe you that this is just diversification, but just in case it's not, we're going to demand a slightly higher return for holding this paper today.
It's fascinating geopolitical poker. You have the U.S. relying on foreign buyers to fund its debt, and one of its biggest historical creditors is slowly but very deliberately backing away toward the exit door.
And doing it while saying, no hard feelings.
Right. It's just business. But speaking of business, let's pivot from the macro gloom to a specific corporate story that is just lighting up the boards today, the redemption arc. We're talking about Aplivin, ticker symbol APP.
If you own this stock, you probably need a stiff drink or a celebration, maybe both at the same time.
The stock is up roughly 15% today. It is ripping. But to understand why that's such a big deal, we have to rewind to last week, because things were looking dark.
Dark is putting it mildly. The company was facing an existential threat. A financial publisher, essentially a firm that investigates companies and publishes reports, often while betting against the stock, a short seller,
Right.
they came out with a bombshell report.
They dropped the M word.
Money laundering.
Now, for our listeners, we need to clarify this. In the corporate world, there are bad accusations like you missed your earnings or your CEO is lazy, and then there are death knell accusations.
Right. Money laundering is a death knell. It's a do not touch sign with a skull and crossbones on it. If a credible report accuses a public company of facilitating money laundering, two things happen instantly. One, institutional investors, pension funds, mutual funds, the big guys, they are often legally required by their own compliance charters to sell.
They have to sell. No choice.
They cannot hold a stock that is credibly accused of criminal financial activity. So you get massive forced selling. The price just crashes.
And what's the second thing?
The banks cut you off. If you are Aplivin and you rely on credit lines and suddenly your banking partners read that you might be laundering money, they freeze your accounts, they call your loans. It can literally bankrupt a perfectly solvent company just by choking off its liquidity.
So the stock was hammered. Investors were pricing in a non-zero chance that Aplivin goes to zero. It was a real possibility.
Exactly. The bankruptcy discount was fully priced in. The market was taking it very, very seriously.
Enter Monday morning, 12:10 p.m.
The financial publisher issues a retraction.
Trantis? My bad.
Essentially, they formally withdrew the claims. And if you look at the chart of the stock today, it is a vertical line, straight up.
It's fascinating to me. The company didn't sell a single extra software license today. Their profits didn't change 1 cent. But the company is worth 15% more than it was at breakfast.
This is the definition of a relief rally. But it's also a powerful lesson in how modern markets work. We live in an era of algorithm trading and high-frequency funds. The second that headline hit the wire, the keywords Aplivin claims, withdrawn, human traders didn't even have time to click buy.
The robots beat them to it.
The algorithms read the syntax, recognized the sentiment shift from deeply negative to positive, and just flooded the order book with buy orders in microseconds.
So the robots bought the dip before the humans even finished reading the sentence.
Precisely. But for the human investor, the lesson here is about binary risk. When you bought Aplivin yesterday, you're making a very specific bet, not on the business, not on their growth, but on the truth. You were betting the report was false.
High risk.
Massive risk. But today, that risk was removed from the equation. And when you remove a, say, 50% chance of bankruptcy, the stock price mathematically has to go up to reflect the new, safer reality. It's not excitement, it's just repricing.
It's like holding a beach ball underwater. The accusation was the hand pushing it down. The retraction is the hand letting go. Boing, up it goes to where it should have been.
That is a perfect visualization, and it highlights how sensitive the modern market is to reputational risk. In the age of algorithmic trading and social media, an accusation travels instantly. But a retraction, well, that travels instantly too, apparently.
It really does. I wonder how the people who panic sold last week are feeling right now.
Probably not great. But for those who held on, or those who were brave enough to buy the dip, gambling that the accusations were false today is a very, very profitable day.
High risk, high reward. Speaking of high risk and high tech, let's widen our lens a bit. We've talked about bonds, we've talked about Aplivin's roller coaster, but there is a lot happening in the broader tech landscape today.
There is. It's a busy day for the chip makers and the software giants. A lot of cross currents.
Let's start with AMD, Advanced Micro Devices. The headline I'm seeing is, AMD stock has strong potential in 2026, despite an early setback.
This is an interesting narrative. AMD had a bit of a rocky start to the year. That's the early setback they're mentioning. But the sentiment from analysts remains incredibly bullish for the rest of 2026.
Why is that? What's driving the optimism if they stumbled out of the gate?
It's the semiconductor supercycle. It's the AI story. We are still in the thick of the AI infrastructure build-out. Every major company in the world is trying to build or buy AI capabilities, and you can't do that without high-performance computing chips. The demand just isn't slowing down.
So it's a rising tide lifts all boats situation.
A huge rising tide. So even if AMD had a hiccup, maybe supply chain snag or a slight earnings miss for one quarter, the broader current is moving so strongly in their favor. The market is looking past the short-term noise and focusing on the long-term demand curve, which still points straight up.
It's the don't miss the forest for the trees argument. The forest is made of silicon and everyone needs it.
Precisely. And speaking of needing silicon, let's talk about Microsoft. MSFT is rising today, and the catalyst is gaming, which feels a little surprising.
Yeah, this caught my eye. Microsoft's stock rises, alongside reports the next Xbox will be a gammon. And the text cuts off, but it implies a gaming-focused device.
Which sounds obvious, right? An Xbox should be a gaming device. What else would it be?
You would think. But remember, for a while, the narrative around Xbox was, it's a service, it's a cloud platform, you don't need a console. The hardware was becoming secondary to the Game Pass subscription.
Exactly. There was a lot of talk about moving away from dedicated hardware. But these new reports suggest the next Xbox is going to be a powerful, dedicated piece of hardware again. And for whatever reason, the market likes that.
Why, though? I thought hardware was a low-margin business compared to software subscriptions.
It is. But hardware anchors the ecosystem. It's the Trojan horse. If you have that box in your living room, you subscribe to Game Pass, you buy the accessories, you buy the games from their store, you are locked in. It seems investors are realizing that even for a software giant like Microsoft, having that physical touch point with the consumer really matters.
It's the anchor. It keeps the ship in the harbor.
And it drives sentiment. Even though gaming is just one slice of the massive Microsoft pie, it's a high-visibility slice. It's the cool part of the company. Good news there lifts the whole mood around the stock.
Now, we can't talk big tech without mentioning Oracle. They are surging today, too.
Yes, Oracle, ORCL, is having a great day. They have been quietly, or I guess not so quietly, positioning themselves as a major player in cloud infrastructure specifically for AI. It seems the market is finally rewarding that pivot and seeing them as a real competitor in that space.
But not everyone is invited to the tech party today. We have to mention Li Auto.
No, we see a clear divergence here. While U.S. tech is rallying, the Chinese EV maker Li Auto, ticker LI, is falling today. And there's a specific name attached to this drop, JP Morgan.
The analysts weigh in.
It appears JP Morgan has been involved in the news cycle regarding this drop. Usually that means a downgrade or a bearish note was published. It just highlights the intense volatility in the EV sector right now. While chips and software are hot, the electric vehicle trade is, well, it's complicated.
Very complicated. And we'll touch on another EV giant, Tesla, in a bit. But first, I want to take a detour into the crypto corner, because if you think the bond market is scary, you should take a look at Ethereum today.
Oh, the charts are looking very dramatic for Ethereum. A lot of worried traders out there.
I saw a headline that actually made me shiver a little. Can Ethereum's price survive the $2,000 death zone?
Death zone. It's very dramatic branding, isn't it?
It sounds like a bad 80s action movie, but what does it actually mean for a regular investor? What is a death zone?
It's a term technical analysts use for a critical make-or-break level. Essentially, $2,000 is a massive support level for Ethereum. It's a psychological line in the sand. Think of it like a frozen lake. The ice is thickest at that $2,000 mark.
Okay.
If the price holds above that, traders think, okay, we're safe, the ice holds, we can keep skating. But if it breaks below $2,000,
The ice cracks.
the ice cracks and you fall into the freezing water. That is the fear. It could trigger what we call capitulation.
Capitulation, that's when everyone just gives up at the same time and sells at any price they can get.
Exactly. It's a panic sale. Stop-loss orders get triggered automatically. Margin calls go out from brokers. It creates a cascade of selling where the price drops simply because everyone is forced to sell at the exact same time. The death zone implies that we are right on the edge of that cliff.
And what's driving this anxiety? Is it just the price action itself, or is there a fundamental reason?
Well, the headline I saw mentions ETF panic.
ETF panic, that's a new one.
Remember, the launch of crypto ETFs, the exchange-traded funds, was supposed to be the golden ticket. It was supposed to bring in all this institutional money and legitimize the space.
Right, the floodgates would open.
But now it seems there's anxiety peaking regarding these funds. Maybe the inflows of new money aren't what people hoped for, or maybe there's fear of regulatory changes coming down the pike. Either way, the ETF salvation narrative is quickly turning into ETF panic.
It's the hangover after the party. Everyone got excited for the ETFs they launched, and now reality sets in.
And that reality is hovering right above the $2,000 ICE. It will be a very tense 24 hours for crypto traders watching that level.
I'll definitely be keeping my eyes peeled. Okay, let's leave the digital world and head to the physical world, the really physical world, outer space.
To the final frontier.
We have a major update from SpaceX. For years, the dream, the goal, the bumper sticker has been one word: Mars.
Mars. Making humanity multiplanetary. That is the core mission statement from day one.
Well, the mission statement just got a rain check. The news today is that SpaceX is officially pushing back its Mars landing.
Yes. The timeline has shifted significantly.
And instead, they are pivoting their focus to a 2027 moonshot.
This is a really significant strategic pivot. It's not just a minor delay.
So help me understand this. Is this a failure? Is this SpaceX admitting Mars is just too hard right now, or is this just pragmatism?
I would argue it is a realignment of reality, a recalibration. Mars is incredibly, incredibly difficult. We aren't just talking about building a powerful rocket. We are talking about orbital mechanics. You can only launch a mission to Mars every 26 months when the planets align in just the right way.
Right, the launch window.
Exactly.
Yeah.
And the journey itself takes 6 to 9 months. The radiation exposure for the crew is massive. It is the hardest engineering challenge humanity has ever attempted. The moon, on the other hand, is right there. It's our celestial backyard.
Much shorter trip.
It's a 3-day trip. You have near instant communication. If something goes wrong, a rescue mission is, well, it's not easy, but it's at least conceivable.
So the moon is the testing ground. It's the dress rehearsal.
That's the perfect way to put it. By focusing on a 2027 moonshot, they are setting a concrete, achievable, near-term goal. It's better to succeed at landing on the moon in 2027 than to keep failing to reach Mars for another decade.
It's like learning to walk before you run a marathon.
Or learning to camp in your backyard before you try to survive in the Sahara. The moon in 2027 becomes the stepping stone. It makes the timeline more concrete. For investors, for NASA, for the public, moon in 2027 feels real. Mars someday was starting to feel like science fiction.
That makes a lot of sense. It's probably disappointing for the die-hard Mars enthusiasts, I'm sure, but for the actual business of spaceflight, it sounds like a mature, logical decision.
It is. It's about sustainable progress, not just headlines.
Now, bringing it back down to Earth, literally, let's talk about the automotive sector. We mentioned Li Auto struggling, but General Motors, GM, is in the news today for a reason that makes me squint a little.
It's an interesting headline coming out of Canada.
It is. Canadian politicians call for tax relief on General Motors' severance.
Now, you really have to read between the lines here.
Yeah, let's parse that sentence. Tax relief on severance.
If politicians are publicly asking for tax relief on severance packages, what does that imply?
It implies there is a lot of severance being paid out, a significant amount.
Which implies significant layoffs. You don't ask for tax relief on severance if you're hiring people. You ask for it when a large number of workers are losing their jobs and getting these big payouts, and you want to soften the blow for them or for the company paying them out.
So this suggests there's some serious restructuring, maybe even a plant closure happening at GM in Canada.
It suggests tension. At the very least, tension between the automaker and the local government regarding how workers are treated as they exit. It's a quiet signal of distress in the traditional auto manufacturing sector.
While the tech stocks and AI companies rally, the legacy automakers are dealing with layoffs and tax fights. It's a really stark contrast.
And just to round out the auto picture, Tesla, TSLA, is also active in the news feed today.
Can't have a market day without Tesla making some kind of noise.
Exactly. They are keeping the EV sector in the spotlight alongside GM and Li Auto. It's a sector in flux, some winning, some losing, some restructuring. A real battleground.
Okay, so let's take a step back. We've covered a lot of ground here. We started with the geopolitical chess match between China and the U.S. Treasury. We watched AppLovin rise from the ashes of a money laundering accusation. We saw the tech giants jockeying for position in 2026. We looked at Ethereum teetering on the edge of a cliff. And we saw SpaceX pivoting from the red planet to the gray one.
It's a lot to digest on a Monday morning.
It is. So if you had to sum up the theme of the day, what is it? What's the thread connecting all this?
I think the word is recalibration.
Recalibration. Explain that.
Think about it.
Yeah.
China is recalibrating its bond portfolio, shifting away from the U.S. dollar, diversifying its risk. SpaceX is recalibrating its launch schedule. Moon first, Mars later. It's a more realistic plan. The market is recalibrating AppLovin's value, pricing out the crime, pricing in the actual business. Even Microsoft is recalibrating its Xbox strategy, back towards a focus on powerful hardware. Everyone seems to be adjusting their settings today.
Everyone is adjusting their settings. I like that.
Exactly. It's not a day of brand new inventions or shocking new trends. It's a day where the world is looking at its existing plans and saying, okay, let's adjust the course slightly based on new information.
And sometimes those adjustments are tiny, like 1 basis point on a yield, and sometimes they are huge, like canceling a trip to Mars for now.
But they all connect. They all ripple through the system.
So for our listener, the learner out there, what's the so what here? Why should they care about all this seemingly disconnected news?
I think the lesson today is about distraction versus substance.
Wow, so.
The headlines that grab you, the ones that get the clicks, are money laundering and death zone. They are exciting, they're dramatic, they trigger emotion. But the thing that will actually impact your wallet, your mortgage, your retirement account in the long run is that boring, tiny, 1 basis point move in the Treasury yield.
The boring stuff is the important stuff.
Always. The China Treasury dynamic is the tectonic plate shifting under our feet. AppLovin is just a firework going off in the sky. It's pretty, it's loud, but the tectonic shift is what actually moves the continents.
That is a great perspective. Watch the fireworks, but keep your eye on the ground.
Exactly.
Before we sign off, I want to leave you with a thought. A question, really. We talked about China selling U.S. treasuries to diversify. We know Japan and the U.K. are buying some of that. But here's the question that's sticking with me. We know China is the world's second largest economy. If they decide to step away from the U.S. dollar ecosystem even faster than expected, who steps in?
That is the multi-trillion-dollar question, isn't it?
Who fills that void in 2026? Is the U.S. market ready to stand without its biggest historical creditor? Or are we going to find out that diversification feels a lot like a divorce when the bills come due?
It's something every single investor needs to be thinking about.
Something to mull over while you watch the ticker tape today. Thank you for diving deep with us.
Stay curious.
See you next time.